Hi guys, welcome back to Chasing Financial Freedom. Rocco Di Pietro here, and today we're going to start our new series, Stock Investing 101. In this series, we're going to talk about the stock market in general. We're going to talk about stock market psychology. We're going to talk about crowd psychology. We're going to talk about how to invest wisely, and we were going to talk about how to make yourself financially free by using this phenomenal motor that is the stock market. So, in the beginning, let us define in clear words what is the stock market. So, the stock market is the place where people come together to buy and sell commodities or to buy and sell stocks or shares of a company. So, if we have a company, for example, LLC or a company that is incorporated, we usually have some stocks or parts of this company that are available for the general public to buy. And in this stock market, so-called stock market, we use brokers to come to this to buy these stocks. And we have a term that is used, Wall Street, and it is a street in the USA where in the past there were uh, going on trading going on, and people were buying and selling those stocks. So, and there on the other side we have the main street, and on the other side there was a fence, and after this fence there were animals. And in the stock market we usually use some animal calling, and we have the bulls which use their horns to put prices up. So this is when we call something bullish, we usually mean that we are expecting it to rise higher. So this is the bullish thesis. And then we have the bears, and the bears are the people who are always betting on falling down, the stock prices falling down. And so the bulls put the prices up or push the prices up, and we have the bears that pushes the prices down with their bears. So the bulls usually think of buying low and selling high, but the bears are shorting the market and betting on the market falling under, and are betting on the market on being lower. So these are essentially the two main camps, as we can say. So we have in the future we're going to talk about some lines, and in these lines we have for example on the upper side where there is the we call it the bulls camp, and this camp are the people who are bullish and usually buying the stock. On the downside we have the bears camp, and they are usually shorting. So as we said, so on the upside of the chart we have the bears, and on the downside we have the bulls. So when the price move up, we have people buying in, and then we come usually to a certain price, and on that price there usually is not enough bulls to push the market higher, and there comes the bears that start selling their shares and putting pressure on the market, and so the stocks go down. And then when we come to the downside, here we have the bulls, and usually there is a price that even the bulls are not comfortable about selling, so they start buying again, and we have a price rise again. So this is what is called a price fluctuation. So we have prices moving, and in these moving prices we have sometimes the moving averages. So we have the average of the price. For example, we bought at 1, then was 2, then was 1, then was 2, then was 1, then was 2, and then we would have a moving average of 1.5. And so this would mean that there is a neutral pattern. But if we had, for example, today a price of the stock of 1, then tomorrow of 3, then of 2, then of 3, then of 1.5, then of 3.5, and then we would have again a 2, then we have a moving average crossover moving ahead. So this is what is called moving average, that is looking up. But then we could have the same thing and the moving average moving down. So we would have some prices that begin with 3, and then we end with 2, 3, 2, 3, 2. And then we go from 2.5 to 1.5. So as you would probably see and understand, that would mean that we have a price average moving down, so downhill. That would mean that we are probably going to see, at least in the short term, we're going to see a decline in the price of the stock. So in the stock market we have some important concepts. We have the trading strategy. So what is our strategy of trading? Are we comfortable holding certain stocks? What is the price of buying price, and what is our exit strategy? So what is our starting strategy for a stock, and what is our out strategy? So this is called trading strategy. Then we have money management. So how do we manage our money? And this essentially means how we manage our money. So how much percent of our portfolio, the total amount of our money that we hold, are we willing to invest in the stock market? So this is something that is important to think about when we are actually entering some positions. And then we have psychology. So psychology, in my opinion, is the most important fundamental aspect of trading that we have to think about. And in the psychology side of things, we have the FOMO, and it is called fear of missing out. This is why we as people buy into stocks expecting them to rise, and when we are FOMO, we fear that we are going to miss on some great investment strategies, great investment opportunities, and so we try to enter as soon as possible. Then another, maybe a little less talk about concept is FOL, and FOL, and it means fear of losing. So here essentially we are afraid that we're going to lose everything, even though it can happen sometimes, or some stocks really go to zero, they go bankrupt, they go to essentially zero value, but most of the time the stock trade at a fair price. And then if we came here to talk about fair price, we have still to talk about what is a fair price. So we have the price that is currently a stock is traded at, and we can think of the price as consensus between a seller and a buyer. So when a seller sells, he thinks that it is a good price to sell, and for a buyer, he usually thinks that it is a good place to buy. So the seller expects the price to go down in the future, but the buyer expects the price to go up in the future. So when we have FOMO, we are expecting the price to move up very much. But when we have fear of losing, then we are expecting the price to fall. So in this sense, we can see that we as humans are very logical beings, and if we are thinking about the future, and if we are thinking about the future in a good way, in a good sense, with optimism, then we are usually going to be bullish. But if we think about the future that is going to go down, then we are bearish. The important thing is to remember that we can make money either way. We can make money trading up, and we can make money trading down. So in the next episode, we're going to continue to talk about market psychology, about fair price, about sellers, buyers, bullish markets, bearish markets, fear of missing out, fear of losing, etc. And the most important thing is that we are going to try to improve every single time. So I will try to make every single episode a better one. So until next time, I wish you good luck in the stock market. Thank you for listening. Bye bye.